Hello, I'm David from Tax Associates. Welcome back to another tax tip. Today, I'll be presenting choosing the best business entity structure post-TCJA. For tax years beginning in 2018 and beyond, the Tax Cuts and Jobs Act, TCJA, created a flat 21% federal income tax rate for C corporations. Under prior law, C corporations were taxed at rates as high as 35%. The TCJA also reduced individual income tax rates, which applied to sole proprietorships and pass-through entities, including partnerships, S corporations, and typically limited liability companies, LLCs. The top rate, however, dropped only slightly from 39.6% to 37%. On the surface, that might choosing C corporation structure seem like a no-brainer, but there are many other considerations. Under prior tax law, conventional wisdom was that most small business should be set up as a sole proprietorships or pass-through entities to avoid the double taxation of C corporations. A C corporation pays entity-level income tax, and then shareholders pay tax on dividends. And also, they pay tax on capital gains when they sell the stock. For pass-through entities, there's no federal income tax at the entry level. Although C corporations are still potentially subject to double taxation, under TCJA, their new 21% tax rate helps make up for it. The issue is further complicated, however, by another provision that the TCJA that allows non-corporate owners of pass-through entities to take a deduction equal as much as 20% of qualified business income, QBI, subject to various limits. But unless Congress extends it, the break is available only for tax year beginning in 2018 through 2025. There's no one-size-fits-all answer when deciding how to structure a business. The best choice depends on your business' unique situation and your situation as an owner. Now, let's see 3 common scenarios. Under the first scenario, a business generates tax losses. For a business that consistently generates losses, there's no tax advantage to operating as a C corporation. Losses from a C corporation can't be deducted by the owners. A pass-through entity will generally make more sense because losses pass through to the owner's personal tax returns. Second scenario, business distributes all profits to owners. For a profitable business that pays out all income to the owners, operating as a pass-through entity generally will be better if significant QBI deductions are available. If not, it's probably a toss-up in terms of tax liability. In the third scenario, business retains all profits to finance growth. For a business that's profitable but holds on to its profits to fund future growth strategies, operating as a C corporation generally will be advantageous. If the corporation is a qualified small business, QSB. Why? 100% gain exclusion will be available for QSB stock sale gains. If QSB status is unavailable, operating as a C corporation is still probably preferred, unless significant QBI deductions would be available at the owner level. So there are many considerations, but these are only some issues to consider when making a C corporation versus a pass-through entity choice. We can help you. Please call us to schedule an appointment. Thank you.